Warren Buffett, one of the world's most successful investors, has turned a small investment into over $100 billion. But how does he do it? The secret lies in the ratios he uses to pick the right stocks. Here's something most people don't know. Buffett's approach isn't about fancy trading or luck. It's about understanding simple numbers that reveal a company's true value. For example, did you know that over 70% of Buffett's wealth came from just 10 investments? That's right, 10. And each one was chosen based on key financial ratios he trusts. In this video, we'll dive deep into the 6 ratios Warren Buffett swears by to build wealth. From spotting undervalued stocks to finding businesses with a strong future, these ratios give you the power to think like the Oracle of Omaha himself. Stick around to discover how using just a few simple metrics can change the way you look at investments forever. Chapter 1. The Golden Rule. Price-to-value ratio. When Warren Buffett looks for investments, he starts with one basic rule: buy something that's worth more than what you're paying for it. One of his favorite ratios to measure this is the price-to-value ratio, often referred to as intrinsic value. This ratio helps Buffett assess whether the stock price is undervalued compared to its true worth. A well-known quote from Buffett says, "Price is what you pay, value is what you get." This sums up why this ratio is so crucial. Buffett uses it to find companies trading below their intrinsic value, which can lead to massive long-term gains. Interestingly, Buffett often looks for stocks trading at a price-to-value ratio lower than 1. This tells him that the market might be underestimating the company's potential. When analyzing, Buffett doesn't just look at short-term trends, he focuses on long-term growth and consistency. A recent study of 400 value stocks from 1975 to 2019 showed that stocks with a low price-to-value ratio beat the market by over 7% per year. But Buffett knows that calculating intrinsic value isn't an exact science, it's more about careful judgment and experience. The key is to understand the company deeply and not just rely on surface-level financials. Chapter 2. The Dividend Dynasty. Payouts. That Matt Buffett has often said, the happiest time in a shareholder's life is when the company declares a dividend. This reveals just how important dividends are to him. But it's not just about the size of the payout, it's about the sustainability. Buffett focuses on the dividend payout ratio to determine if the company can consistently afford to pay dividends. The dividend payout ratio compares how much a company pays in dividends to its net income. A high payout ratio might seem attractive, but it could signal trouble if the company is not earning enough to cover its dividends. In contrast, a lower payout ratio often signals a company with room to grow or reinvest in its business. Buffett likes to invest in companies with a moderate payout ratio because it shows they're balancing growth with returns to shareholders. The average dividend yield for S&P 500 companies has hovered around 2% for the past decade, but Buffett typically looks for a yield that's above average in sectors like consumer goods. One standout example is Coca-Cola, a company that Buffett has held for decades. Its consistent dividend payments and moderate payout ratio are key reasons why he's stuck with it. Companies that regularly increase their dividends signal financial strength, which Buffett highly values. A study in 2018 found that dividend-paying stocks outperformed non-dividend-paying ones by nearly 2% annually over the last 90 years. Chapter 3. Profitability Power. The return on equity secret. Buffett once said, "The first rule of an investment is don't lose money. The second rule is don't forget rule number 1. A key metric he uses to help avoid losing money is the return on equity, ROE. ROE measures how effectively a company uses its shareholders' equity to generate profits. The higher the ROE, the more efficient the company is at turning investments into profit. Buffett looks for companies with an ROE of at least 15%. This indicates that the company is producing solid returns from its equity base. An important fact here is that the average ROE of S&P 500 companies in 2020 was about 14%, which shows how competitive the market is. Companies with higher ROE ratios often have strong management teams that know how to leverage assets for growth. When analyzing a company, Buffett looks for consistency over time. A company that delivers a strong ROE year after year, even during tough times, shows resilience. For example, Buffett's investment in American Express was largely driven by its consistent ROE performance, which outpaced many of its competitors. Another fascinating aspect of ROE is its ability to predict long-term growth. Studies show that companies with high ROE tend to outperform low ROE companies over a 10-20-year horizon. Remember to subscribe if you're enjoying the breakdown of Warren Buffett's top investing ratios. You don't want to miss the next chapters. Chapter 4. The Debt Dilemma. Keeping leverage in check. Buffett is known for his caution regarding debt, once remarking, "I've seen more people fail because of liquor and leverage," leverage being the key word. Debt can be a double-edged sword. While it can help a company grow, excessive debt can lead to financial ruin. That's why Buffett pays close attention to the debt-to-equity ratio. This ratio compares a company's total debt to its equity, giving a snapshot of its financial leverage. A lower debt-to-equity ratio indicates that the company is less reliant on borrowing, which is generally safer. Buffett prefers companies with a ratio of 0.5 or lower, which means the company has less debt than equity. For instance, when analyzing Berkshire Hathaway, Buffett noted its low debt levels, which allowed it to thrive during market downturns. A study by McKinsey & Company found that companies with high debt-to-equity ratios were 40% more likely to fail during financial crises. In the 2008 financial crisis, companies with low leverage were better able to weather the storm. This is why Buffett likes to avoid businesses that are highly leveraged or dependent on borrowing to fuel growth. Chapter 5. Earnings over everything. The cash flow crucible. Buffett famously stated, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." But how does he determine if a company is wonderful? One of the main tools he uses is cash flow. Cash flow is the lifeblood of a business, and Buffett places a high value on it. Operating cash flow, OCF, is particularly important because it reflects the company's ability to generate cash from its core business operations. Buffett looks at this ratio to make sure that earnings aren't just on paper. They must be backed by actual cash coming in. This is a crucial indicator because companies can manipulate their earnings through accounting practices, but they can't fake cash flow. For instance, Buffett's investment in Burlington Northern Santa Fe was heavily influenced by the company's strong and predictable cash flow. Companies with healthy cash flow are better positioned to handle downturns, reinvest in their business, or return capital to shareholders. A study by J.P. Morgan Chase in 2020 found that companies with strong operating cash flows outperformed those with weaker cash flows by 10% annually. Buffett believes that cash flow is more reliable than earnings because it's harder to manipulate. Chapter 6. The Moat Metric. Understanding competitive advantage. Buffett has often referred to the concept of a moat, which is a company's ability to maintain a competitive edge over its rivals. He believes that companies with strong moats are the best investments because they can defend their profits from competition. One of the ways Buffett evaluates a company's moat is through its return on invested capital, ROIC. ROIC measures how well a company generates profit from its capital. A high ROIC indicates that the company is earning more on its investments than its competitors, which is a sign of a strong moat. Buffett's favorite companies are those that can grow without requiring significant capital investment. For instance, Buffett's long-term stake in Coca-Cola is due to its massive brand moat and ability to generate high ROIC. A study by Morningstar in 2019 found that companies with a wide moat outperformed those without a moat by over 4% annually. Buffett's philosophy is that a strong moat allows a company to raise prices, maintain market share, and stay profitable in the face of competition. Companies with wide moats, like Apple or Disney, can often reinvest their profits at high rates of return. This is why Buffett often focuses on industries where moats are present, like consumer goods or technology. If you found this content useful, make sure to hit that subscribe button. Stay tuned for more tips on how to invest like Warren Buffett.